Welcome to the Capital News. I am your host, Alex Karitis. Today is May 23rd, 2019. Thank you so much for joining me. So the markets continued their sell-off today quite aggressively. And the S&P lost 34 points, representing a 1.2% decline. The Dow lost 286 points, representing a 1% decline. The Nasdaq lost 122.5 points, representing a 1.6% decline. And the Russell 2000, the small cap index, lost 30 points, representing a 2% decline. Now, the Nasdaq, the Dow, and the S&P were able to get a little bit of a boost at the end of the day. Was this the result of President Trump coming out and giving a little bit of a press conference at the end of the day, trying to give a little boost? Is it coincidental that the president got on the air at the end of the trading session? Maybe, maybe not. Or is this perhaps some profit-taking by the markets? Now, there were also some technical levels also where the S&P, Dow, and Nasdaq were trading throughout the day, and so they were able to sort of follow their support level, and that's where they ended up closing. So tomorrow it's going to be interesting to see what happens, if the selling continues or if the market is able to stage a little comeback, if people think, well, this is an opportunity to buy the dips. This is just a correction in what is deemed the bull market that will go on for forever and forever. Of course, that is not what we prescribe to here, but it is a possibility. Every day is different, especially when you're only one tweet away from a spectacular market rally or a spectacular crash. And unfortunately, that's the truth of the matter. Again, this is an abuse of power by the president anytime he interjects in the marketplace, because he knows that he is moving markets. This is not his arena. This is not what he was elected to do, nor should he be doing this. And again, I hope that he, a member of his family, a friend, his organization, anybody he is associated with, is not profiting from having knowledge of what the president is going to be saying or tweeting, because he perfectly knows well that he moves these markets. And to me, that's just a bridge too far. It's an abuse of his executive power as far as I'm concerned. Now, looking at the Dow Jones Transports, something we were discussing here yesterday, and again, this will be something that may be part of the mix of our discussion as we move forward, because it is something to pay attention to. It is a leading indicator. We lost 160 points on the transports today, representing a 1.6% decline. Oil, well, what a doozy oil took today. This was a 4 to 5% decline if you're talking on the WTI or Brent. So we are now at $58.70 a barrel on WTI. Brent is now trading below $70 a barrel and now sits at $68.69. This is on the back, not on unexpected inventory increases. This is on trade concerns, which again I think is overblown. This is just an excuse. This is a crutch. The real reason is because I think the markets are finally wising up to the fact that this global economy is slowing down and it is rolling over. And they're just finally starting to realize it. We were hoping for the past 5 months, almost 6 now, because we're at the end of May already, that the Federal Reserve and other central bankers were going to come to the rescue. They did slightly. They did a 180 policy reversal. Also, we have the president tweeting on a near daily basis, or a member of his administration coming out and saying there's going to be a great, historic, fantastic deal between the United States and China. So everybody was hanging their hat on hope. Hope is not a strategy. I don't know how many times I have to say it, but I will gladly continue saying it, because that's all these markets were clinging to. Central bankers and presidential tweets. Now, if you think you can conduct some sort of financial or economic analysis off of those two things, well, God bless you. Because who knows what's going to come out of the mouths of any central banker, or what's going to come out of the mouth of Donald Trump or his Twitter page. Nobody has any idea. And even if something is said from the central bank, primarily from Chairman Jerome Powell of the Federal Reserve, he might walk it back. Or we might actually see former Chairman Janet Yellen and or Ben Bernanke come out and say, oh no, Jay didn't mean to say that. What he meant to say was this, that, or the other. Or another member of the Federal Reserve Board will come out and say, well, yeah, Jay was just misspeaking once again. I mean, everybody's credibility is shot. You can't trust the Federal Reserve, which is a no-brainer here. We want them gone, and the Fed. And now the president's credibility, from me, somebody who supported and voted for the president, his credibility is now in question because he has been stringing along the American people in the financial markets around the world saying that there's going to be a fantastic deal between the United States and China. And of course there isn't. And now we are escalating. There are tensions increasing. We have tariffs that are now being implemented. We have more tariffs waiting in the wings, potentially to go into effect next month. We have the Chinese tariffs expected to go into effect at the beginning of June. We have no idea if President Trump and President Xi are actually going to meet at the G20 meeting next month in Japan. We know that there have not been any further discussions in regards to trade. Both nations have not met. We have not sent our trade representative and Secretary Mnuchin over to Beijing, nor has anybody from China been back to the United States since the escalation. All we have had is further escalation and strongman rhetoric from the U.S. and from the Chinese. So this is starting to carry over. This is being prolonged. The markets were not anticipating this. You had trillions of dollars in global equity gains over the past several months, really, quite honestly, with all of these tweets of grandeur. Things are going to be fantastic. And now, that's not a reality. It ain't coming true. And so now we're seeing the reverse. But these markets, at some level, are still clinging to hope because despite the fact that there is escalation and we continue to see more and more negative economic news come out, this market is still clinging to hope that something can be done because I would have thought that the markets would have sold off more aggressively. Now, that's not to say that, that's not going to happen, but I am somewhat surprised at how resilient everybody is staying in this market, clinging to hope. Now, of course, that could be through some sort of manipulation with the plunge protection team. The Federal Reserve could be in there doing some things. I mean, it's a rigged system, folks. We talked the other day about how several banks were fined $1.2 billion by the European Union for rigging the foreign exchange market. $1.2 billion amongst 5 or 6 banks. I mean, that's nothing. That's nothing. That's a flea on a dog. It's annoying. They got to pay the fine, and they're not paying it. The executives aren't paying it. The traders who engaged in the fraud are not paying it. The shareholders are. The owners of the company, of the banks are. But of course, $1.2 billion, everybody sort of, oh, that's a big number, $1.2 billion. That's going to hurt them. How much did they make? They probably made 5 times that easily. So you know what that means? Crime pays. They're going to take that deal every single time. They got a bad headline? Who cares? Maybe you have one too many headlines. The CEO's got to go. But don't worry, folks. He's going to get a package, $50 million to retire. You don't got to worry about him. That's the world we live in. Crime pays. This is why they continue to get away with this. Nobody went to jail, by the way. They were just fined $1.2 billion. The EU got their money. The banks can continue doing what they're doing. And maybe they'll get caught doing something else. But don't worry, nobody will go to jail. Everybody will be just fine. It's a true shame. But again, with the oil markets, the prices going down. We said this yesterday, actually, in fact, that we are anticipating here at the Capital News that the price of oil will continue to decline. The only thing that could keep it elevated or cause some sort of spike is a geopolitical risk. And God knows there are enough of those waiting in the wings. We're still meddling in Venezuela. We're saber-rattling in the Middle East, particularly with Iran. Anything could happen. There could be a reversal overnight. That's the truth. Now, is that likely? Probably not, but it is a possibility. So again, the overarching trend of the oil markets, in our opinion, is to the downside because we have slower growth. If there is a major geopolitical event, then we could see that reverse. But that is what it's going to take. Now we have gold trading at $1,283 an ounce. Silver, $14.54. So a little gain for both of the metals today. But on the silver side, still below that $15 break-even cost for the mining industry. So again, if you're inclined to purchase precious metals, buy low, sell high, we have seen quite the decline recently in silver. So we're still at those levels. So take advantage if you believe that that is prudent. The 10-year U.S. Treasury took a beating. losing 4 percentage points, now sits at 2.296%. 2.296%. This is the lowest the 10-year has traded since 2017. This, again, is on the backdrop of people going to what they deem as a safe haven bet. They think Uncle Sam is a safe haven bet, which historically speaking he has been. Now, this pretty much just signals what we've just stated previously, that the global economy is slowing down, that market participants are understanding this. They are grasping reality finally. I don't know how long-lived that's going to be. I don't want my optimism to get the best of me here, because anything could turn on a dime. But nevertheless, people are positioning how you would think that they would have been positioning for quite a while. And so we are seeing massive buying in the 10-year U.S. Treasury, pushing yields down. Again, 4 percentage points for one day. That is huge, sitting at 2.296%, the lowest level since 2017. Markets are concerned. People are concerned. They are flying to safety. Now, typically when we see this, we may also witness an increase in the stock market because people are saying, well, you know what, we're not earning anything by sending our money away for 10 years with the U.S. government. Maybe we'll go with stocks. But now you're in this paradigm where we want safety. We don't want the risk. Because earlier in the year, we were seeing that. We were seeing, well, we're going to be buying bonds, we're going to suppress rates, and then that's going to say to people in the market, well, we're clinging to hope, so equities are the better buy. We're willing to take that risk, get the higher yield. Let's go into the stock market. Well, as of late, they have been moving in tandem. If you have the yields going down, we are also seeing the stock market going down with it. Now, this is the trend that we have been witnessing over the past couple of weeks. Can this reverse? It most certainly can, because we never know what a central banker is going to say. We never know what the president is going to be tweeting. So I would like to tell you what's going to happen, but I can't, because there are so many uncertainties with those types of individuals. And again, it is a crying shame that those institutions and that individual carries that much power and authority and influence over these markets and over the economy. That, by definition, tells you that this is not a free market capitalistic system. I mean, it's more of a state-run economy. This is more reminiscent of China than it is Americana history, early 1900s. So please, spare me the argument when people get out there and they blame free market capitalism for our woes of the day. Not even close. This is centralization. This is total control by the government, total control by the central bank. And the president has put himself right in the center of it, taken ownership of the economy and the stock market like a fool. And I think it might be a power trip with him right now, to be perfectly honest with you, with him tweeting and manipulating these markets, because he knows he is manipulating them, which again is a bridge too far for me. Now we see the volatility index, the VIX, gained 14 percentage points for the day, now sitting at $16.92. Now, some of the economic headlines that continue today, which are still negative, we have U.S. new home sales fall more than expected. Now, we were talking yesterday about U.S. existing home sales. This is U.S. new home sales are also falling more than expected. We have the U.S. services activity expanding the least amount in over 3 years. We have U.S. private sector growth at 3-year lows. And the icing on the cake, the cherry on top, we have the IHS Market U.S. Manufacturing PMI dropped to 50.6 in May from the previous month of 52.6. And the market expectations were of a reading for 52.5. So we sat at 50.6. The market was anticipating 52.5. It was the lowest reading since September of 2009, as new orders fell for the first time since August 2009, while output and employment rose less than expected. So September and August of 2009. Interesting, isn't it? It's quite a while. Not good, folks. What was taking place in 2009? Oh, that's right. We were in the midst of the financial crisis. Now, again, in fairness to this number, this is the preliminary number of 50.6. Again, if it's above 50, we are still showing expansion. If it's below 50, we're in contraction. So we are still by the skin of our teeth above 50.6. So this is still showing signs of expansion, but at a lower rate. And of course, this is the worst reading in a decade. Not good, because a decade ago we were in the midst of the financial crisis. Now, how the president can come out in light of all of this information and look the American people in the eye, because he says this to them, and the camera too, and how he can go out on Twitter, reaching millions of followers, how can he say with a straight face that this is the best economy in U.S. history? I mean, it ain't even close how bad this economy is. I appreciate the president wanting to be a cheerleader, I really do. But I would rather him be an honest, forthright leader, because that's what this country needs. That's what this world needs, because we talk about politics and economics and leaders, or the lack thereof, all around the world, and it's all the same baloney, it's all the same BS from all of these politicians, all of these central bankers. I mean, this guy, the president, was elected, I thought, to be somebody different. He wasn't supposed to be the typical politician. And in a lot of respects, he is not. But nevertheless, this exaggeration and these flat-out lies are a huge disservice to this country, to the American people. And it needs to be discussed. And I wish some of these reporters could ask some serious questions, but they're more focused on these bogus investigations and impeachment. But that's the world we live. We got a three-ring circus going on down there, so we can't be surprised that those are the types of questions that are asked. Now, real quickly, I do want to take us around the world to the global equities markets, because this is a global situation. So as I speak right now, we have the Japanese markets down 0.7%. The British markets today closed down 1.3%. The Germans closed down 1.8%. The French closed down 1.7%. The Italian markets are continuing to get battered. They lost 2 percentage points for the day. The Spaniards lost 1.4%. And the Aussies, they're currently trading, as I do this podcast, they're down 0.7% as well. The Shanghai markets, which are also trading right now, are up just a couple of points. And our friends to the north, the Canadians, they lost over 1% in trading during today's session as well. So this is global. This is a contagion, and that's what I want to talk about next, because I know earlier this year, during our list of 30 market risks for 2019, which was put together by Deutsche Bank, and of course we have added to that list as we've made our way through the year, but this list was put together by Deutsche Bank, and immediately following our discussion of that, I added another risk to that list, and that had to do with Deutsche Bank collapsing, failing, filing for bankruptcy, having some major issues, right? Because there was no way that Deutsche Bank was going to put themselves on that list of market risks for 2019. There was no way. But I have no problem putting them on the list. And rightly so, because it was only maybe a month or two ago we were talking about how the Germans were thinking it was going to be a great idea to merge their two largest banks together, Deutsche Bank and Commerzbank. Now, there were some negotiations between the banks and the government trying to get this deal to go through, but now it's pretty much falling apart. The bankers really don't want to get together. You had the German finance minister and some German regulators saying this is going to be one of the greatest things in Germany ever. You know, they're doing their exaggeration and hyperbole. I mean, because if you understand these two banks, Deutsche Bank and Commerzbank, they're terrible banks. I mean, it's not even funny. Their exposure to the derivatives markets, their amount of debt, both of their share prices are in the toilet, and that's what I want to talk about today. So merging two pieces of crap together thinking you're going to get a diamond is just unbelievable. I mean, the Germans are supposed to be smarter than that, but this is what I'm talking about. Everybody is clinging to hope. It's the world over. It's not just here in the United States. It's everywhere. The Germans actually thought, well, maybe if we can merge these two pieces of crap banks together, we're going to get a diamond out of it. Well, not even close. Not even close. And now that deal of merging these banks together probably ain't going to happen. Now, Deutsche Bank, their share price is in the toilet. It is hitting all-time lows on a daily basis. It is now trading at $7.23. Just for a little perspective, pre-crisis, right before the 08-09 crisis, Deutsche Bank was trading at $146 a share. $146 a share pre-crisis, It is now trading at $7.23 a share. You have some analysts, some banking analysts out there who are saying if this should go to $6.50 or slightly below, that's it. It's game over. They're done. All investors who remain in the bank will flee, and then you will have a Lehman-like event. And of course, I'm talking about Lehman Brothers and how that was just really one of the largest catalysts of the 08-09 financial crisis. And by some analysts out there, they think that Deutsche Bank is Lehman Brothers on steroids because there are different lending standards, there are different regulatory standards when it comes to U.S. and European banks, which is true anywhere. You have different regulatory environments. The way that it works, just real briefly, is European banks, by their nature, because of the regulatory structure, tend to be more highly levered than U.S. banks. That's why I'm saying this is Lehman Brothers, or can be Lehman Brothers, on steroids if Deutsche Bank does fall. They have been in the toilet for a long time. They are losing money. They are bleeding money. They just simply are not able to make it anymore like they used to be able to. They are riddled in scandal with money laundering. I mean, dealing with some pretty bad characters. A lot of things are coming to light, so there's a lot of class action lawsuits. There's a lot of fines that they have been having to deal with, a lot of legal issues, obviously. So, I mean, it's not good business for the banks, especially not for Deutsche Bank. Plus, you are living over there in Europe with negative interest rates, which does not help banks make money should they be loaning money, which is their business. They are supposed to be lending money. Well, if they're dealing with negative interest rates, which I said, hopefully that does not take place here, but they can't make money doing traditional banking. Now, on their investment side of things, some areas are doing well, others not so well at all. And we actually had the CEO of Deutsche Bank out yesterday saying, well, we're going to have to continue with some cuts. Now, he was not very specific as to what that meant, but this CEO has not been shy of making some difficult decisions and cutting a lot of departments and cutting a lot of jobs. And that is what is being expected and anticipated in the markets, that Deutsche Bank is going to have to shed a lot of jobs. And they are obviously a global bank, but I think most of them are probably likely to be in Germany, which is in a very precarious situation because they just released their first quarter GDP figures, and we saw a 0.4% increase in GDP. That's all it is. Q1 GDP is at 0.4%. And you have markets, they breathed, they took a sigh of relief. That's what they did because they were on the verge of going into a technical recession. Because if we look at last year, that's what we were seeing. We saw no growth. We saw negative growth. 2 quarters back to back of negative growth is a technical recession. So by the skin of their teeth, they averted a technical recession. And now the markets took a sigh of relief. And now by 0.4%, is where the Germans stand. That ain't strength, because they're supposed to be the power horse, the power center of this economic engine in the European Union. Well, 4.4% ain't going to cut it, especially when you have one of your largest financial institutions, Deutsche Bank, in a lot of trouble. How are you going to bail them out? What are you going to do? You don't have enough money. Believe me when I tell you. I think they have like $800 billion in debt if you look at their balance sheet the last time I looked at it a couple months ago. I mean, and you're talking about a market cap, which is almost nothing at $7 a share. Almost nothing. So they have a big problem on their hands. Now, if you recall from the financial crisis in 08-09, there was some finagling that was done by the U.S. government, the Federal Reserve, and some other banks that were able to, quote-unquote, save or absorb some of the other failing institutions. And what I am referencing here is how J.P. Morgan purchased Bear Stearns, which was collapsing. However, with the assistance of the Federal Reserve and the government, meaning you and me, the taxpayer, J.P. Morgan pretty much acquired Bear Stearns. So some of that quote-unquote contagion was contained for a short period of time. Of course, we tried to cling to some sort of semblance of free market capitalism and saying, well, we're not going to be bailing everybody out. And of course, Lehman Brothers met the same fate, and the market did not want to see more and more bailouts. And that's what happened. We didn't bail out Lehman Brothers, so Lehman Brothers went down, and this kicked off a whole host of contagion around the world. This wasn't just obviously domestic to the United States. This kick-started a huge crisis around the world. Deutsche Bank has the same potential of doing that. Dare I even say here in the United States that General Electric, yes, GE, could kickstart a massive problem in this country as well, because their share price is below $10 as well. And they are riddled with a whole bunch of debt. They are trying to sell off divisions. So my focus here today is obviously on Deutsche Bank, but this is a contagion that will not be contained, because I don't think the Germans have enough money. And if they do have enough money to bail them out, where is the appetite going to be for it? Because we are in the midst of EU parliamentary elections. We know that Chancellor Angela Merkel of Germany is set to be leaving. So what type of government will be taking over in the country of Germany? What type of members of European Parliament will they be sending to Brussels? So will they also take place with a populist uprising? And will they tolerate bailing out another major bank? These are serious questions. So no surprise that we see these markets continuing to sell off. Barring some tweet or some stupid comment from the president or some central banker, this market should continue to go down on the fundamentals of the global economy. But we are not living in a world based off fundamentals. So stay tuned. We will find out what happens tomorrow. Thank you so much for joining me. Please like, share, subscribe, get the word out. Leave your comments. We do love hearing from you. This is the Capital News. I am Alex Koritis. Godspeed.